Fiserv 2023 third quarter earnings conference call. All participants will be in a listen-only mode until the question and answer session begins following the presentation. As a reminder, today's call is being recorded. At this time, I will turn the call over to Julie Chariell, Senior Vice President of Investor Relations at Fiserv.
Thank you and good morning. With me on the call today are Frank Bisignano, our Chairman, President, and Chief Executive Officer, and Bob Hau, our Chief Financial Officer. Our earnings release and supplemental materials for the quarter are available on the Investor Relations section of Fiserv.com. Please refer to these materials for an explanation of the non-GAAP financial measures discussed in this call, along with the reconciliation of those measures to the nearest applicable GAAP measures. Unless otherwise stated, performance references are year-over-year comparison. Our remarks today will include forward-looking statements about, among other matters, expected operating and financial results and strategic initiatives. Forward-looking statements may differ materially from actual results and are subject to a number of risks and uncertainties. You should refer to our earnings release for a discussion of these risk factors. And now I'll turn the call over to Frank.
Thank you, Julie. And thank you all for joining us today to discuss how Fiserv continues to deliver very strong results. For the third quarter, we posted 12% organic revenue growth, with margin expansion of 290 basis points to 38.1% on an adjusted basis. These results reflect an acceleration in our merchant acceptance and fintech segment organic revenue growth to 20% and 6%, respectively. While all three segments contributed to higher margin, adjusted earnings per share of $1.96 was up 20%. Cash flow was strong as well, with $1.3 billion of free cash flow in the quarter and $2.7 billion year to date. Once again, strong quarter results point to full year performance ahead of our prior guidance. In the closing months of 2023, market projections in consumer spending and card account growth in the U.S. point to consistency versus third quarter levels, which would mean some softening year over year. Macro uncertainty remains high, but we are confident in our ability to continue to add new clients, grow with and retain existing ones, and expand our share of wallet with all of them. Because of this, we expect to close the year with growth similar to the year-to-date results. We also look at more durable characteristics of our business to support our optimism. Nearly half of our volume in our merchant business is in non-discretionary spending categories. Approximately 85% of our financial institutions' revenue is recurring. Our solutions in both areas serve as essential functions for our clients. Our customer base and distribution network are industry-leading. Our incremental margins are high, and our expense-based benefits from technology-driven efficiencies and discretionary investment that we can adjust to match market conditions. It is these characteristics that have helped us deliver 37 consecutive years of double-digit adjusted earnings per share growth, and 2023 year-to-date results point to this being our 38th year. Our strong execution across these factors leads us to raise our guidance for the remainder of the year. We now expect 2023 organic revenue growth to reach 11%, the top end of our prior range of 9 to 11%, and our adjusted operating margin to improve more than 175 basis points this year, up from our prior expectation of at least 150 basis points of expansion. With this, we are raising our full year adjusted earnings per share guidance to a new range of $7.47 to $7.52, up 5 cents at the midpoint and representing growth of 15 to 16% over 2022. We are also raising our free cash flow guidance from $3.8 billion to approximately $4 billion this year. The third quarter marked our 10th consecutive quarter of double-digit organic revenue growth, and we are focused on sustaining this momentum. Last quarter, I talked about 5 powerful opportunities that can help us do this. So I'll share some proof points we achieved in the third quarter. Let's start with Clover, our market-leading cloud-based SaaS operating system for small and medium-sized businesses. Revenue growth accelerated in the third quarter to 26% from 23% in Q2 on $272 billion in annualized payment volume, up 15%. We released a new Clover dashboard with improved user experience that expedites navigation to our top apps, including reporting and analytics. We added other features that speed the buying process at Clover.com and improve the application process for new merchant prospects. We expect this functionality to open opportunities for Clover with a long tail of merchants growing our addressable market. Value-added solutions penetration continues to grow, reaching 17% in the quarter. We see plenty of white space still ahead, including with vertical-specific solutions, horizontal value-added services, and software and international markets. We retain line of sight to an acceleration in revenue growth that results in $3.5 billion plus in Clover revenue by 2025, the target laid out at our March 2022 investor presentation. Moving to Carat, our unified commerce offering for omni-channel merchants. We added several new enterprise clients and relationship extensions, including a large petro seller and a major grocery chain, adding to our non-discretionary spending categories. We continue to drive value-added solutions with enterprise clients, and wins in the quarter came from products addressing PBACs and platforms, foreign currency translation, fraud, and hotel restaurants with BentoBox. We're pleased to announce that PayPal has selected Fiserv as its core U.S. partner for payment services across both PayPal and Braintree assets. This is a new direct strategic multi-year partnership covering several products and services and millions of merchant locations that builds on a long-standing base of business between our two companies. International expansion continues with Carat, and we had several wins in the quarter across our regions. In EMEA, we won a competitive bid to help Compass Group, the world's largest contract food service company, build unattended food retail services across 14 countries in Europe. We are providing acquiring, local payment methods, and real-time inventory data across our single Carat omni-channel platform for Europe. Our differentiation lies in our functionality around data normalization, real-time access, visualization, and reporting depth and breadth. In Asia Pacific, we extended our global merchant acquiring relationship with Avis Budget, one of the world's largest car rental providers, into Australia and New Zealand. And lastly, an emerging opportunity for us in the enterprise space is open data. We logged 2 important wins in this area in the third quarter. that demonstrate strong demand for access to our vast alternative data assets. One of the major credit bureaus will use our account-level data to add micro indicators to a consumer's credit profile, particularly relevant for the underbanked. Secondly, we're partnering with Dun & Bradstreet to add information from our merchant volume database to supplement its small business credit reports. The solution can optimize credit decisioning for lenders and access to capital for small businesses. Finally, in the area of payments and open banking, we signed a deal with Plaid for API access to bank data, allowing the company to move further away from screen scraping and generating revenue for us and our connected bank and credit union clients. We can further penetrate this data market opportunity by contributing in areas such as ID verification, account verification, loan origination, and security and fraud services. Latin America represents another standout growth opportunity. The region is about 6% of total company adjusted revenue, and in merchant acceptance, it's 10% of adjusted revenue. It's largely driven by Argentina and Brazil, followed by Mexico, Colombia, Uruguay, and the Caribbean. Argentina inflation and anticipation revenue have grabbed much of the attention here, but our business in the region is well diversified with multiple growth drivers across products and countries. Even as we look to presumably less inflation and slower anticipation growth in Argentina next year, we see plenty of opportunities for strong growth in the region. These include instant payments in Brazil and Argentina, revenue growth on our Software Express rails from expanding the payments functionality for this leading retail software business that we acquired in 2018. We expanded on this opportunity earlier this month when we acquired SkyTap, the largest distributor of Software Express in Brazil. With it, we added hundreds of ISV partners, 27,000 merchants, and the ability to cross-sell multiple value-added solutions. Ramping up new business with CaixaBank, including acceptance at 13,000 bill payment facilities across Brazil. Rolling out Clover more broadly in Brazil next year, and expanding our issuer processing footprint with First Vision in Brazil, Mexico, and Argentina. Elevated inflation and high interest anticipation revenue in Latin America have contributed to the high teens growth we are posting this year in our merchant business, well ahead of our medium-term guidance of 9 to 12%. The macro forces contributing to this greater than anticipated growth will likely ease over time, and this assumption is fully incorporated in our plan to achieve $10 billion of merchant revenue by 2025. And finally, in the area of digital payments, we were very happy to introduce yesterday a partnership with Melio, a leading B2B payments platform. This marks a significant step forward for Fiserv into this very large and growing market. Together with Melio, we will enable financial institutions to better meet the payment needs of small businesses and level the playing field with emerging software-led competitors. We will combine Melio's well-known, easy-to-use accounts payable and receivable workflows with Fiserv's market-leading biller and merchant network, plus payment capabilities. By summer 2024, we will go to market with Cash Flow Central by Fiserv, an integrated accounts payable and receivable solution for small businesses through Fiserv financial institution clients. This exclusive distribution agreement includes more than 3,500 FIs currently using check-free from Fiserv for bill payment and will allow the solution to scale rapidly. Furthermore, in the near future, we will reach merchants directly with this product through Clover and our ISV channel. Now let me turn the discussion over to Bob for more detail on our financial results.
Thank you, Frank, and good morning, everyone. If you're following along on our slides, I will cover details on total company and segment performance, starting with our financial metrics and trends on slide 4. As Frank said, our third quarter was very strong. We are confident in our new 2023 outlook and ability to continue to deliver attractive levels of growth and profitability. Total company organic revenue growth was 12% in the quarter, with strong growth across merchant acceptance and a solid recovery and growth in the fintech segment. Year-to-date, total company organic revenue grew 11%, led by the merchant acceptance segment, which grew 17%. Total company adjusted revenue of $4.6 billion grew 8% for the quarter, despite a meaningful foreign currency headwind. Adjusted operating income grew 17% in the quarter to $1.8 billion, resulting in adjusted operating margin of 38.1%, an increase of 290 basis points. Year-to-date, adjusted revenue grew 8% to $13.4 billion, and adjusted operating income increased 16% to $4.8 billion, resulting in adjusted operating margin of 36.1%, an increase of 250 basis points. Adjusted earnings per share for the quarter increased 20% to $1.96 compared to $1.63 in the prior year. Year-to-date, adjusted earnings per share increased 16% to $5.34 at the high end of the 14 to 16% annual prior guidance range. Our adjusted earnings per share growth is particularly noteworthy given the impact of foreign currency translation. Mostly due to the sharp devaluation of the Argentine peso relative to the dollar, our earnings per share includes a headwind of 24 cents for the quarter versus prior year. Free cash flow reached $1.3 billion for the quarter, up 48% versus the prior year, and $2.7 billion for the first 9 months of the year, up 29%. We are raising our free cash flow guidance and now expect to reach $4 billion this year, reflecting the typical strength in our cash flow generation in the second half of the year. Now looking to our segment results starting on slide 5. Organic revenue growth in the merchant acceptance segment was a strong 20% in the quarter and 17% year-to-date. We now anticipate organic revenue growth to be in the high teens for the full year. Adjusted revenue growth was 12% in the quarter and 11% year-to-date. Organic revenue growth in this segment is running well ahead of our medium-term guidance for 9 to 12% growth, driven by growth in Clover, our ISV channel, and our international businesses, as well as several transitory factors that we expect will ease in future years. The elevated Argentine inflation, which is running well above 100% this year, contributed about 2 points of organic growth for the segment on a year-to-date basis. Additionally, high interest rates in Argentina have contributed to a stronger growth in anticipation revenue. But even as rates normalize, we expect demand for these prepayments to be healthy given the extended settlement periods here, as well as in Brazil and Uruguay. Turning to volume performance in the quarter, merchant volume grew 2% overall and 6% excluding wholesale processing. Similarly, transactions grew 1% overall and 9% excluding processing. Recall that a large portion of our volume comes from traditional wholesale processing. However, over the last several years, we've been evolving from providing processing services alone to offering full acquiring services and, more recently, software and other value-added solutions. This transition changes our business model for the better. Our SMB and enterprise acquiring businesses carry much higher revenue per dollar volume compared to the wholesale processing business. So, as acquiring grows and wholesale processing becomes a smaller portion of our volume, we are seeing a widening positive spread with revenue growth outpacing volume growth, in large part due to value-added services. Going forward, processing volume will ebb and flow. As a reminder, we projected $10 billion of revenue in this merchant acceptance segment in 2025, with processing revenue roughly flat from 2021 to 2025. We expect overall revenue growth will continue to outpace volume growth as we increase penetration of software and services, which means more revenue per unit of volume. Clover continues to build on the strength of its growing product offering, distribution partnerships, expanded direct sales, and value-added solutions. It posted a strong 26% revenue growth for the quarter and 23% year-to-date. Quarterly Clover GPV was $68 billion, or $272 billion on an annualized basis, up 15%. Value-added services penetration was 17%, over 2 points above year-ago levels, and on track to achieve our 25% target by 2025. Carat, our omnicommerce operating system for enterprise clients, grew 14%, excluding the loss of a large merchant aggregator as discussed last quarter. On an unadjusted basis, Carat revenue grew 2%. We had 2 large wins that included our Commerce Hub product, the new single orchestration layer that enables easy access to all of our products and services. First, with Curb Mobility, the taxi hailing service, and second, with Autobooks, an accounting and bookkeeping system provider to small business. Adjusted operating income in the acceptance segment increased 24% to $757 million in the quarter, and adjusted operating margin was up 350 basis points to 35.9%. Year-to-date, adjusted operating income improved 22% to $2 billion, and adjusted operating margin grew 300 basis points to 33.8%. Turning to slide 6, the payments and network segment. Organic revenue growth in the segment was 6% in the quarter and 9% year-to-date. Adjusted revenue growth in the quarter was 5% and 8% year-to-date. Growth drivers in the segment include North American credit active accounts on file, though growth here slowed a bit to 3%, and Zelle transactions grew 44%, which continued to benefit from new uptake of Zelle for Business. Our debit networks, Star and Excel, added several new merchant customers, including some household names in e-commerce, in part to take advantage of Reg II benefits. These and prior new client adds represent a strong pipeline of prospects for the merchant acceptance business. We also won a deal to support Pinnacle, a $42 billion bank by assets, in a combined debit processing and network win, demonstrating our ability to successfully support and sell to larger banks. Outside the U.S., we closed a 5-year deal with a Tier 1 UK bank to support the launch of a new Buy Now, Pay Later solution to be delivered using a combination of our First Vision processing technology and our new suite of digital solutions. We also won a contract with Bandhan Bank, India's 8th largest bank, further cementing our position as a market leader in credit processing in India, bringing the number of Indian banks on our First Vision processing platform to 10th. As we've said, we expected tougher comparisons through the second half of the year, given the anniversary of the onboarding of several large clients through mid-2022. We continue to anticipate the full-year organic revenue growth rate to be toward the high end of our medium-term outlook of 5 to 8%. Adjusted operating income for the segment was up 12% to $832 million, and adjusted operating margin was up 270 basis points to 48.6% in the quarter, driven by favorable mix and greater productivity. Year-to-date, adjusted operating income was up 14% to $2.3 billion, and adjusted operating margin was up 260 basis points to 46.7%. Moving to slide 7, the Financial Technology segment. Organic revenue growth in the segment was 6% in the quarter and 3% year-to-date. Adjusted revenue growth in the quarter was 4% and 1% year-to-date, impacted by the divestiture of our financial reconciliation product announced at the beginning of the quarter. For the year, we expect organic growth to reach the low end of our guidance range of 4 to 6%. Adjusted operating income was up 11% in the quarter to $291 million and up 5% to $856 million year-to-date. Adjusted operating margin in the segment increased 260 basis points to 36.7% for the quarter. For the first 9 months, the segment's adjusted operating margin grew 130 basis points to 36.1%. We added 8 new core account processing clients in the quarter, including 3 wins with financial institutions whose assets exceeded $1 billion. 2 wins came from growing credit unions, including Noble Federal, that saw the benefits of upgrading to DNA, our industry-leading cloud-enabled core for both credit unions and banks. The adjusted corporate operating loss was $120 million in the quarter and $384 million year-to-date. The adjusted effective tax rate in the quarter was 19.2% and was 19.6% for the first 9 months. We continue to expect the adjusted effective tax rate to be approximately 20% for the full year. Total debt outstanding was $23.3 billion on September 30th, and the debt to adjusted EBITDA ratio dropped to 2.8 times. During the third quarter, we issued $2 billion of 5-year and 10-year senior notes to replace the notes that matured in October and reduce our commercial paper program balances. Variable rate debt sits at 7% of total. During the quarter, we continued executing our capital allocation strategy, repurchasing 9.6 million shares for $1.2 billion and 31.4 million shares for $3.7 billion over the last 9 months. We had 60.5 million shares remaining authorized for repurchase at the end of the quarter. We are fully committed to our long-standing disciplined approach to capital allocation, which includes investing in our business organically, maintaining a strong balance sheet, returning cash to shareholders through share repurchase, and pursuing high-value and innovative acquisitions. And wrapping up on slide 8. Year-to-date organic revenue growth is at the top end of our prior guidance for the full year, and we expect the level of business activity in the fourth quarter to be similar to the third. While consumer spending is forecast to be slower in the second half of the year relative to the first, the consumer has remained resilient as unemployment levels remain low. Bank and credit union IT spending continues at a healthy pace as higher interest rates have been a tailwind for profitability. The combined scenario gives us confidence to raise our full-year organic revenue growth to 11%, the top end of our previous guidance range of 9 to 11%. Based on this higher anticipated organic revenue growth and strong third quarter results, we are raising our full-year adjusted EPS guidance range once again from the previous $7.40 to $7.50 to a new range of $7.47 to $7.52, representing growth of 15 to 16% over 2022. This includes a higher adjusted operating margin, now expected to improve more than 175 basis points this year, up from our prior guidance of at least 150 basis points. We look forward to seeing you at our Investor Day on November 15th. Space is limited, so for those of you who cannot attend in person, please take advantage of the webcast from our Investor Relations website. With that, let me turn the call back to Frank.
Thanks, Bob. I'll provide a brief update on our CSR activities and most recent recognitions before we wrap up and move to Q&A. During the quarter, we continued to expand our focus on minority depository institutions, or MDIs. In September, we hosted our inaugural MDI Advisory Council meeting, where we discussed future state products and strategies and how to better integrate Fiserv solutions at council members' banks to help them grow and better serve their clients. We were active on the Back to Business front as well. So far this year, Fiserv's Back to Business program has funded almost 200 grants totaling nearly $2 million for small, diverse merchant businesses. Also, in the third quarter, our leadership position in fintech was affirmed when IDC ranked Fiserv #1 on its top 100 ranking of global financial technology providers. CNBC also named us a top fintech company, and Time magazine included Fiserv on its list of world's best companies in 2023. I'd like to conclude my formal remarks with what to expect from our upcoming investor conference on November 15th. This will be our first full business review in 3 years. Our work to integrate First Data and Fiserv is not only done, but it's driving real value in the marketplace across merchants and financial institutions in a way that only this combined company can. Our assets are now unmatched when you consider that we have a large and diverse client base, from financial institutions of all sizes to small businesses to large enterprises around the world, spanning all sectors and containing many leaders in their respective industries. A global footprint in over 100 countries, organized by region and known for deep local expertise. A modern stack computing environment with private and public cloud capability. Scale-based leadership in merchant acquiring, driven in part by a superior distribution model. The largest SMB SaaS payment platform by volume with Clover. The leading credit card issuing platform offering cutting-edge cardholder experiences. The #3 debit network. Our Now network that optimizes connections between our bank and credit union clients and payment rails of all types, from cards to ACH to real-time. The best bank and credit union account processing platforms and the broadest set of value-added surround solutions. And finally, cross-platform opportunities that expand our addressable market and that Fiserv is uniquely positioned to deliver. This includes our new SMB accounts payable and receivable market opportunity and our embedded finance offering, where our newest fintech platform, Finxact, is enabling banking services offered by merchants, starting with one of the world's largest retailers. We'll expand on these opportunities and more in a few weeks' time. And we'll share a compelling 3-year forward plan that will help you understand how we intend to defend and extend our lead in fintech. Thank you to our teams who come to work every day to build and deliver on this plan. And thank you all for your time and attention today. And now, operator.